Martin Kocher, thank you so much for joining us, Austrian National Bank Governor and also ECB Governing Council member. We do appreciate your time on CNBC.
Thanks a lot for having me.
First up, let me probe around the interest rate path we've seen from the ECB to date. Has it been appropriate to reduce interest rates to the current level, given the growth challenges and where inflation sits today?
We have, of course, a situation in Europe where the growth is not as high as we would want it to be, actually. But for the ECB's policy, the interest rate and, of course, the inflation rate is important. And the inflation rate is pretty stable, around 2%. That's the target of the ECB. So we are in a good place, and the rates have been reduced over the last couple of months, but we are steady since spring. And as long as nothing changes dramatically, I think we're in a good place what interest rate policy concerns.
When you say nothing changes dramatically, it's been a year of flux. We've seen so many external threats. Domestically, there's been a big fiscal package coming through out of Germany and obviously from the Europeans as well. There's been a lot of change. So how do you weigh up some of that change?
You're absolutely right. And that's surprising to a certain extent. We've seen a lot of risks, upside, downside risks, lots of things changing geopolitically in the trade area. But with regard to the numbers we get in the projections for the inflation rate, for the growth rate, and also what we get from financial markets, we see quite some stability. And as long this is there, I think we're in a good place regarding the interest rates. But of course, things might change quickly. It's important to keep your powder dry and be able to act at any moment in time when things might change, when we need to change. And that's the reason why we have a meeting-to-meeting approach. We look at the data, and the new data that comes in tells us whether there might be changes or not.
It's been an era of a real lack of forward guidance. Do you think that's just the moment we live in? Do you think it changes down the track?
The uncertainty level that we have, policy uncertainty, but also other uncertainties are pretty high. So that means forward guidance is very difficult because you would actually pre-commit on something that you cannot deliver on perhaps later on. So I'm a supporter of the current state that we actually look at the data meeting by meeting, look at what we have, assess what we have, and then take the right decisions. Forward guidance would actually limit the ability to react to whatever we have to react. And given the risks I mentioned and you also mentioned, I think it's important to have that power to act at any time, and forward guidance would reduce that power, actually.
I want to ask you about the growth opportunities for next year, because the market, investors, economists are all looking for this fiscal story to play out of Germany. I think it'll be a real driver for the engine in Europe. Do you see that, or are there obstacles to the smooth sailing of that German fiscal program?
We've seen in the euro area 2 or 3 years with quite low growth rates, actually. And so I think many people are quite pessimistic given this experience. But you're absolutely right. There is a couple of issues that can also create some optimism, and we see some spending increases, we see some better business opportunities, we see, of course, some effects that come out of this long period of sluggish growth. We have a high savings rate that might, to a certain extent, translate into consumption very soon, and all that could also lead to a stronger growth than we actually expect at the moment. The expectation at the moment is around 1% growth rate for the euro area next year, but it might also be higher. So the upside and the downside risks for growth, they are quite balanced in my view at the moment.
I want to ask you about the tariff impact. I know a lot of the ECB Governing Council members were concerned about the tariff impact, that it could chip away at growth. It could also bring more products into Europe, some recognition that maybe there are more Chinese imports at this stage. What happens from here? Because we still have a US-China at loggerheads, no resolution there. Is there still potential for the trade story to have an impact on Europe?
So trade contributes to this policy uncertainty at the moment. I think we are in a better place than we were in spring, where the uncertainty was very, very high also between the European Union and the United States. The deal that has been struck creates some certainty about the future, but the problem with trade data at the moment is that they are quite volatile and there's some front loading, so it's quite difficult to interpret what we are seeing. At the moment, we see less of an effect of the trade conflicts in the data than we expected. That's true for the European Union, but also true for the US in the price level data. I would not bet on that this stays on like that. There might be changes that only trickle down over time. But we'll have to wait and see, and you're absolutely right. These trade diversion effects that we might experience through Chinese trade rerouted to the European Union, that might affect, of course, also our inflation expectations.
Speaking of inflation, there's a lot of discussion that the ECB is stuck with the twos, 2% growth, 2% on the interest rate and 2% on inflation. But the latest inflation rate came through a little bit higher at 2.2%. And if you look at the services side again, still above 3%. Is there an inflation problem still lurking for the ECB to tackle?
Our current projection for 2026 is 1.7%, so slightly below the 2% target. But you're absolutely right. There were some small revisions over the last couple of weeks and months upwards with regard to inflation rate. And service inflation is higher than the target inflation rate. I think this is a reminder that we should remain vigilant and see what's happening. But at the moment, inflation expectations are well anchored. There's no reason to expect higher inflation rates than the target. But again, there might be changes given this geopolitical uncertainty that we are seeing.
I think it's fair to say the market is trying to get a handle on whether the ECB members are quite dovish at this point, aware of some of the potential risks from here. And Christine Lagarde this week was talking about not ruling out a further rate reduction, that maybe you're not done when it comes to easing. Should we interpret that as being fairly dovish, or is that just optionality?
I think it's the latter, it's optionality. We cannot exclude that there's something to happen that might make us move. At the moment, I think we're, as I said, in a good place. So there's no reason to change anything as long as there are no changes that force us to do something. And if you take the larger picture, yes, the easing cycle is close to an end or at its end, but there's no reason to pre-commit at that stage.
We keep talking about downside risks, but are there upside risks? Do you see the ECB having to hike at any point?
Not at the moment. On the other hand, as I said, there might be stronger forces to growth than we expected from a reduction of the savings rate, from the spending initiatives, from other sources that we don't see at the moment, and then things change. But not at the moment. Again, upsides and downside risks, I would say, are pretty much balanced at the moment.
Let me tackle one of the topics for the ECB watchers, and that is how you will approach monetary policy. Your predecessor, Robert Holzmann, was a noted hawk. And what has been discussed so far is that you have your own style, you're quite distinct. How would you say your style is distinct from Robert Holzmann?
I mean, not at all. We are, of course, all representing ourselves in the governing council. I think everybody has a different approach, and probably he started in a very similar way as I started. At some stage, you will be put into some pocket, and somebody will call you either hawkish or dovish. But my background is in economics as a professor, so I like to be evidence-based and data-driven, and I think that's exactly at that moment of time a very good approach. Let's look at the data, let's see what we have, and then decide. And at some stage, after a couple of years, perhaps there will be some pocket you'll be put into, and you'll have your name actually.
So you're warning us not to put you in the hawk or the dove camp just yet.
Yeah, absolutely.
I want to ask you about QE, because there was another big discussion that's been raging in the last week or so, some of it triggered by the Treasury Secretary, Scott Bessent, talking about overreach by central banks and using QE during the last crisis. What do you think? Was it appropriate to use those creative monetary policy tools to do whatever it takes to save the system?
I think it's good to have a toolkit that is broad and that is actually available for exceptional times. I think everybody knows that these times of very low interest rates and QE were times that had side effects that are not very desirable. And whether it was successful or not is a discussion among scholars. And I think nobody wants to go back to this time. So that this should remind us of what we're doing now, that we're not getting back into a time with very low interest rates and large-scale programs, purchasing programs that might not reach their targets fully. But that doesn't mean that the toolkit is not helpful in certain instances. So I think that's the important distinction. Yes, the toolbox is important and we might need it again at some stage. Was it a desirable moment of time? Was it something that we liked to do? I think no.
Do you think that ultra easy policy has created the consequence today where we have these huge fiscal deficits, huge debt loads to try and tackle? Is that one of the reasons why we're facing such a tough road ahead when it comes to those debts?
To be honest, I don't think that the debts are directly related to QE. I mean, partly they might be related, but we've seen, of course, exceptional times over the last 4 or 5 years, the COVID pandemic, then the wars we are facing, and energy price hikes in some parts of the world. All that, of course, contributed to what we're seeing nowadays in terms of fiscal policy. So I wouldn't assign it alone to the time of QE and asset purchasing programs. But of course, together it created what we're seeing now. And of course, the ECB is rolling back these purchases. So everything is fine. We are on track. But there are some effects that are not completely desirable, and I completely agree with you here.
I also want to ask you about the big conversation point in Europe, which is about European competitiveness. There have been changes made, there have been labs that have been created to try and create innovation, projects to get Europe moving more quickly, faster decision making, less red tape. What do you want to see happen in 2026 to make Europe more competitive?
There's lots of things that could happen, and we have a blueprint. The Draghi report, the Letter report, they give us a lot of guidance what would be helpful to do. And the European Commission has a pretty ambitious agenda. And hopefully it will be able to implement those things. For monetary policy, of course, capital market reforms are very important. The European capital market is not, it is still more fragmented than I want it to be. It is still not used enough. We still have an outflow of capital from the European Union to other parts of the world, and there is too little investment, especially for what we need in terms of energy transition and infrastructure. So capital market reforms are an important part of the overall reform to make the European Union more competitive.
And just finally, let me ask you about central bank independence. Yeah. We are seeing this tested here in Washington, D.C., the attacks from the US president on the Federal Reserve. Even recently, we were talking about whether Japan, whether the BOJ would be allowed to increase interest rates, given there had been a change at the helm of the government in Japan, and a noted Dove who wanted interest rates lower. How do you see the independence issue, and is there a risk for financial markets if central banks are not allowed to remain independent?
Independence is important to be able to take, if necessary, unpopular decisions. And this is in the interest of citizens, because if you take unpopular decisions at a certain stage, it reduces the cost of inflation over a long period of time. We've seen that in the 70s and the 80s. Central banks were not that independent at that time. It took much longer to bring rates down, and it took very, very painful measures at some stage also in the US in the 1980s. Now we have seen an inflation period, for instance, in the European Union, in the euro area, with inflation rates very high, close to that in the 1970s. And after 2.5 years, we're back to the target because of central bank independence. So I think it is not a privilege. It is in the interest of citizens. And I hope that this is seen everywhere in the world, because it helps everybody to implement measures that are in the interest, in the long-term interest of the economies and the societies.
And Martin Kocher, thank you so much for joining us, Governor, Austrian National Bank, and also ECB Governing Council